Hundreds of small and regional banks across the U.S. are under significant stress. Over 280 banks face the dual threat of commercial real estate loans and potential losses due to higher interest rates. We will likely see more bank failures, or at the very least, some will dip below their minimum capital requirements. However, these challenges primarily affect smaller banks rather than the major financial institutions. The rapid hikes in interest rates have increased loan payments, which borrowers might not be able to afford, leading to potential defaults. A record $929 billion in loans is maturing in 2024, partly due to extensions of loans initially due in 2023. Regulators are proactively working with at-risk lenders, issuing confidential reports to ensure these banks raise their capital. By attracting private capital, the aim is to minimize bank failures. Many of these stressed banks may need to raise capital or seek acquisition by stronger banks, although mergers and acquisitions in the banking sector have slowed significantly. The stress on these banks can have substantial implications for the U.S. economy, especially for communities reliant on smaller banks. The U.S. banking system comprises around 4,600 banks, with about 4,000 being small or community banks. Collectively, these small banks hold assets comparable to America's largest bank, J.P. Morgan Chase, with $3.2 trillion in assets. The stress is shifting to community banks, which have between $1 billion and $10 billion in assets. These banks are likely to face significant challenges. The Claris Group analyzed 4,000 banks, focusing on those with over 300% of capital in commercial real estate loans and potential interest rate losses. Their analysis identified 282 U.S. banks at risk, with nearly $900 billion in total assets. Most of these are smaller banks with less than $10 billion in assets each, while 16 have assets ranging from $10 billion to $100 billion. Smaller banks play a crucial role in supporting communities, especially away from the coasts. Regional banks, about 130 in number, control just under $3.1 trillion in assets and are vital for smaller businesses, local governments, and nonprofits. Without these regional lenders, businesses may have to turn to larger banks, which might offer less favorable terms. Despite the stress, most banks are not insolvent but are experiencing financial strain, which impacts their ability to invest in new branches, technology, or hires, thereby subtly hurting communities over time. For depositors, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000, ensuring that individuals are protected if a bank fails. Commercial real estate loans are a significant concern, as higher interest rates make loan payments more expensive, increasing the risk of defaults. Federal Reserve Chairman Jerome Powell has acknowledged the likelihood of some bank failures. The Federal Reserve has raised interest rates 11 times since March 2022, leading to significant unrealized losses on banks' balance sheets. These banks must manage their interest rate risks effectively. The Fed is cautious about future interest rate changes, but the stress on banks remains high. Stressed banks can either shrink to match their capital or raise new capital. Fortunately, the solution should involve private sector capital rather than government bailouts. Mergers and acquisitions, M&A, could also help stressed banks. For instance, New York Community Bank raised over $1 billion from investors, strengthening its position. However, 2023 saw a 40-year low in bank M&A with fewer than 100 acquisitions. Regulatory scrutiny on M&A deals has increased, making it challenging for banks to merge. Regulators are actively working with bank leadership to address these challenges. They aim to ensure banks raise capital, sell assets, and improve their financial health without causing systemic issues. While some bank failures are expected, attracting private capital and allowing M&A could reduce the number of failures. The current banking stress is different from the Great Financial Crisis, which involved significant bank failures. Today, the focus is on smaller community banks rather than the large interconnected banks that are vital to the economy. Even if a small bank fails, the overall economic impact is manageable. Ultimately, the goal is to support the banking system through private sector solutions, ensuring stability and reducing the risk of widespread failures. This situation will likely unfold over the next few years, with continued attention from regulators and efforts to bolster the financial health of smaller banks. Given this outlook, it's crucial to consider protecting yourself outside the traditional banking system. Explore options like physical gold and silver to safeguard your wealth. Stay informed and share this message with your loved ones. If you have questions or want to learn more about protecting your assets, we are here to help. Please like, subscribe, and share your thoughts in the comments below. Your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.